Welcome to our halftime report presentation. We are delighted to see all of you here today inside of the webinar and look forward to sharing some important information with you. As we get started, let's start with some formalities. Please take a moment to read some of the disclosures on the screen, and please let me say this at the beginning of the presentation. Today, I'm going to make a lot of remarks about the S&P 500. And the S&P 500 is a composite index of unmanaged stocks that is generally considered to be representative of the U.S. stock market. Index performance is not indicative of past performance of a particular investment. Past performance does not guarantee future results. Individuals cannot invest directly into an index. And also keep in mind that the return and principal value of stock prices will fluctuate as market conditions change. And shares, when sold, may be worth more or less than their original cost. Now that we've gotten some formalities out of the way, let's kind of jump into stuff. So I'm here to help you better understand what happened in the markets in the first half of 2021 and what may unfold in the months ahead. If you have questions during this presentation, at the end of this presentation, there is some links and you can schedule a call or schedule a meeting or whatever you would like to do. Before I move from here, what you'll all notice is that you do have handouts. You're able to download these slides in PDF format. And if you'd like, you'll see that in your handout section of the little bug that's on your screen. And you can go ahead and download those to PDF. Again, if any questions come about during today's webinar, please reach out to us, email, click one of the links at the end, what have you. Okay. So let's jump into stuff. Today's agenda, we're going to do a review of the first half of the markets. We're going to take a closer look at what drove U.S. equity performance, and we're going to give some predictions for the second half of the year. So even though it's impossible to cover everything that happened so far, we believe that focusing on some key developments may help give a clearer picture of the markets. So let's jump into it. Let's begin by reviewing how the stock market performed during the first half of 2021. Here's a snapshot of the S&P 500 index performance from December 2020 to the end of May 2021. Again, the S&P 500 tracks the market capitalization of 500 large domestic stocks. The index is commonly viewed as a benchmark for analyzing the performance of the U.S. economy. Let's look at some key events that affected stock performance in the first half. As we review these milestones, keep in mind that the period was marked by an unprecedented combination of economic recovery from a historic economic contraction, fiscal stimulus, and continued monetary accommodations helped this market grow through the first half of the year. The set of conditions that are helping this market grow will not last forever. So investors should expect that the return and principal value of stock prices will fluctuate as market conditions change. The S&P 500 climbed rather steadily during the first 6 months of 2021. Despite the headwinds of political uncertainty and a slow start to the vaccination rollout, markets did really fantastic. As the inauguration of President Biden proceeded to schedule on, investors were soon able to focus on the economic fundamentals and progress in managing COVID-19 infections and getting America vaccinated. Markets were lifted by a series of positive developments, whether in the form of additional fiscal spending or the acceleration of vaccination. March saw some particularly noteworthy developments. There was a passage of a $1.9 trillion stimulus spending bill, and a milestone was achieved with 100 million vaccinations administered. In April and May, In April and early May, markets reacted to solid economic numbers, highlighted by the April jobs report and calculations that the U.S. economy grew at a 6.4% annualized rate for the first quarter on our GDP numbers. Markets also digest an inflation report that showed a 4.2% increase in consumer prices on a year-over-year basis. We're going to talk more about that GDP at 6.4. We're going to talk more about inflation. We're also going to talk more about CPI and core CPI and how this will affect the markets moving forward. If you all maybe remember, at the beginning of the year, every year when we do our market update, at the beginning of the year, we kind of show you this chart. And what we show you is at the beginning of the year what some big banks, big analysts predict where the S&P 500 will close the year at. As a reference point, as of the close of business yesterday, the S&P 500 closed at 4,358. As I am on the phone with you right now, on the webinar right now, the S&P is at 4,328. Okay. As you can see at the beginning of the year, this group average of analysts predicted that the market would close, the S&P 500 would close at 4,278. Again, close of business yesterday, we were at 4,358, so well above analyst predictions. So, as we kind of move forward here, it can be hard to predict the future. So let's talk about some stuff here. With the approval of several vaccines, more effective vaccination efforts, and additional financial stimulus, market sentiment improved as investors became increasingly optimistic that the country might avert another wave of COVID-19 infections. And the pieces were in place for an economic reopening. In the following slides, we'll take a look at the country's progress in fighting COVID-19 and examine how the progress was reflected in the key drivers of stock market performance. This chart shows the relationship between changes in the S&P 500 performance and the 12-month forward earnings per share, or EPS. As you can see, the two lines generally move in the same direction. And they have over the past decade, okay? But what has happened in the last year? The volatility in stock prices and earnings as a result of COVID-19 kind of made this chart change a little bit. As you can see, the relationship kind of reverted in the last year, and that's a lot to do with COVID. As the market rebounded in expectations of economic recovery, earnings appreciated a bit slower to track higher stock prices. Thus, there's today a wide gap between prices and earnings. Will they drift back to the historic relationship? That's unknown. Only time will tell. But if history can teach us anything, this gap will definitely, or should definitely, start to close. Again, here's a couple reminders. Past performance does not guarantee future results. Over the next 10 years, the correlation between stock prices and corporate profits may look much different. And second, individuals cannot invest directly into an index. Market conditions can definitely change. To unpack this chart for you, all this is basically saying is when we look at forward earnings of companies, okay, and where their stock prices are, obviously, if companies are expected to earn more money, their stock price matriculates to the upside, again, depending upon market conditions. So let's keep looking at what drove equity performance during the first half of the year. Let's see how we got here. To put today's economy in perspective, let's look back to January 2011, when it appeared that the 2008 credit crisis was behind us. It was finally receding. Here you see 20 speedometers representing 20 indicators that we look at here at Triumph Capital Management, from corporate profits to energy costs. As you can see, 16 of the 28 indicators were in some shade of green, green obviously being positive. And with green, it suggests the economy had a solid foundation for moving forward. Just one indicator was fully in the red, as you can see, back to January of 2011, and that was the political environment. Okay, let's move forward here. If we fast forward to January of 2021, so 7 short months ago, you can see that 10 of the 20 indicators reported positive or in the green and strengthening numbers. But you can see that an equal number of indicators had a neutral or negative rating, so in that red or orange type of realm. In particular, the political environment and geopolitical risk were in the red. It seems to me we've been doing these market updates, twice a year, 3 times a year for the past decade or so. The political environment has never been fully in the green. We'll see it somewhat improving here. So our speedometers, if I fast forward a little bit more, and I look at April of 2021. So by April, the speedometers indicated a much improved outlook. 17 of our indicators were green, 3 were yellow, and none were red. These improving conditions reflected a number of key developments, including an acceleration in vaccine distribution, falling new infection cases of COVID-19, additional fiscal stimulus, and improving economic numbers. Let's keep working here. Let's spend a few minutes looking at the path of COVID-19 infections and vaccinations. Some believe progress on this health issue was a necessary precondition to the economic recovery. As the chart illustrates, new COVID-19 infections appear to have peaked over the latter part of 2020 and in early 2021, followed by a sustained downtrend by mid-January. This decline helped investors believe we might avoid another strict lockdown. And obviously, as people came out of lockdown, you started to see Americans with pent-up demand start spending again. We're going to talk more about that. So one of the reasons for the downward trend in new COVID-19 cases was Americans were being vaccinated at greater numbers. After a slow start, the environment of national drug retailers helped accelerate the pace of vaccinations in both March and April. As the chart illustrates, about 50% of the U.S. population had received at least one vaccination by June, setting the stage for a broad economic reopening in the second half of the year. In addition, nearly 90% of people over age 65 years or older have received at least one vaccination shot. All right. Inflation. So inflation's kind of a funny thing. When we look at inflation at the highest level, the Federal Reserve has 3 functions to provide an effective payment system for the U.S., regulate banking operations, and conduct monetary policy. So again, the Fed really has 3 mandates. They want to create an effective payment system for the U.S., regulate banks, and conduct monetary policy. Out of those 3 functions, the biggest influence on the market is monetary policy. So when conducting monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether to adjust interest rates or not. The Fed has stated it's comfortable with inflation in the 2% range. All right, we're going to unpack this. This line graph shows the core consumer price index over the last 50 years. The core CPI tracks what urban customers pay for a specific group of goods. Now, when you look at core CPI, it doesn't include energy or food. So when the Fed looks at this and they look at core CPI, they take out inflation for energy and food or deflation for energy and food. Okay, you can see on On this particular chart, you can see in the last ticks of the chart, the pandemic influence over inflation trends was dramatic but not unprecedented. For example, when most states were urging residents to stay at home in May of 2020, energy CPI, as you can see on the chart, dropped 18.9%. This deceleration in inflation did reverse in the second half of 2021. Especially as the economy opened up, as pent-up customer demand and supply chain constraints sent prices higher. Inflation worries have crept into the market, and I'm going to unpack how that all works together, and we're going to discuss these worries of inflation, their effects of the market, especially over the first half of the year, and how they may play into the second half of the year a bit later throughout this presentation. The other things I want to call your attention to is the 50-year average of inflation has been 3.9%. As you can see, really, since about 1998, we've been running well below the 50-year average of inflation. And as some of you in the webinar today can remember, inflation where we were back in the 70s and early 80s. We kind of got inflation under control as we got into the mid-80s. And of course, and relatively tame, over the last 30 or so years. Let's take a moment to talk about wages and unemployment. This graph shows the unemployment rate and year-over-year wage growth over the past 50 years. Do you notice anything about how these two lines relate to one another? You can see there's somewhat of an inverse relationship. When one goes up, the other goes down. However, notice how wages rose while unemployment spiked during the pandemic period, right? That wasn't an inverse relationship. It was kind of something new. One of the reasons for this break in the wage growth unemployment relationship was that job losses were mostly in the low wage areas of the economy that were shut down by the pandemic, such as hospitality industry workers and bars and these types of things. Remarkably, just a year after unemployment jumped to 15%, as you can see on the slide, right? During the pandemic, we had unemployment. It jumped to 15%, the highest, absolute highest it's ever been, okay? And where we are today. Unemployment today, which was reported on May 27th, so just about a month ago, 6.2%. Interestingly enough, the 50-year average of unemployment is 6.2%. Now remember, one of the Fed's mandates is to keep employment at a certain keep employment and therefore unemployment at a certain level. Sometimes when we do this market update, people say, well, unemployment's at 6% or wherever it's at. Healthy, by the way, healthy unemployment is someplace around 3%. You may say, well, how can that be healthy? Why would you want 3% unemployment? Well, you need to have some unemployment so that there's room for businesses to hire employees. Okay, so again, remarkably, at the peak of this pandemic, unemployment jumped to 15%, and as of our May reading on unemployment, we're just right on the 50-year average at 6.2%. Okay, the other thing I want to draw your attention to is wage growth. So when you think about wage growth and you think about inflation, inflation is just the price of things going up. So pretend you have a consumer, a U.S. citizen, who drives to and from work every day, right? They just have their to and from work every day. The price of gasoline's going up or going down. Well, if the price of gasoline is going up, it costs that consumer the same, it costs them to, they're still driving the same mileage. It costs them more at the pump. When it costs them more at the pump, they have less money to spend on purchasing other things, such as whatever widgets, right? A new Apple cell phone or whatever the case may be. Consumer spending represents 70% of the United States of America's GDP growth. And so when you have inflation that's rising, okay, That's troublesome for the market because that consumer is maybe not spending as much money on those other widgets, if that makes sense. There's also some other concerns for inflation. It has to do with the Fed. We're going to unpack that here in a few slides. But I'm bringing it up now because the one thing that fights inflation is wage growth. If you have inflation that goes up at 2% and you have wage growth that goes up at 4%, well, you catch my drift. Americans really got a raise. However, if you have wage growth at, say, 4% and inflation at 5%, you can see the issue there. Now, of course, the 50-year average on inflation has been 3.9, as you can see on the chart here, right? I'm talking about wage, right? But the inflation rate has been 3.9, as we saw in a previous slide. Here's the thing. If we go and we look at CPI, okay, so inflation year over year is reported at the end of May, we had an inflation year over year of 4.9%, 4.9%, okay? We had wage growth year over year from March to March of 4.4. This caused some shakiness inside of the markets, and we'll talk a little bit more about how that inflation affects the Fed, but let's keep working here. Consumer sentiment. So the University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how average consumers feel about the economy. The index is extremely valuable, and it surveys at least 500 residents of the continental U.S. each month by phone. The survey uncovers consumers' opinions regarding their own finances, as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending, as I mentioned earlier, represents more than 2/3 of gross domestic product, or our GDP. As the chart indicates, after the pandemic consumer confidence, as you can see that big, huge line that drops off, you can see that at least the consumer confidence index is coming back. And American consumers are becoming, more confident in 2001, especially as vaccinations roll out and economies open back up. In March, for instance, consumer confidence reached its highest level in a year and appears to be trending higher, as you can see on the graph. Okay. Now, just to unpack consumer confidence, you might be like, well, does that really make a difference? Here's why it makes a difference. I want you all to think back to 2008, and I like to use this example. Say, for instance, in 2008, you and your spouse worked as educators. You were both teachers, okay? I like to use the teaching profession as an example because it's agnostic to the economy. You're going to show up to work Monday for Friday. You're going to earn the same paycheck, basically, and you know that your company's not going to go out of business. In other words, the kids are going to be at school. You show up at school. You're teaching. Whether the economy's doing really well or the stock market's doing really well or really poorly, you know what your salary is. However, if you think back to 2008, just pretend you were in a job like that, like education, and this weekend you're over at the neighborhood cookout. And at the neighborhood cookout, you say, hey, geez, where are the Jones? And somebody at the neighborhood cookout says to you, hey, the Jones, they foreclosed on their mortgage, right? You say, oh, my goodness, I can't believe that. They lost the house. And, another 3 or 4 weeks go by, you're at the cookout again, and now it's the Smiths. Well, even though you and your spouse are both educators, in other words, your salary is not going to be messed up, in the back of your mind, you start to think to yourself, hey, I ought to tighten my belt, right? I might not go out there and buy that new widget, that new gadget, or whatever the case may be. So how people feel, right, does kind of dictate how they spend. And so we like to see consumer confidence kind of moving in an upward direction because it's positive for the economy, which is therefore positive for, the markets, right? All stocks is they're selling a widget, and hey, are people going to buy the widget? Housing, to kind of flip the screen here, is an important contributor to economic growth. New housing starts can increase demand for everything from labor and construction supplies to appliances. If you think about it, some of the reasons for how the tax code's written today, you get to write off your mortgage interest. If you own rental, you get to depreciate, even though the asset's appreciating it. A lot of times clients ask me about that. Doesn't make any sense. I get to depreciate it. Well, the reason for that is, think about it. If you went out today and you bought a new home, well, think about all the economic activity that you create. It's like throwing a pebble into a puddle, and that puddle's ripple effects. You probably hired a realtor. There was a title company involved. Now you got to go out there and you have to furnish the place, probably buy new linens and things, maybe new TVs. Think of all the economic activity, okay, that's created by existing home sales, okay? So as we look at this chart, you can again see that existing home sales can fuel increases in improvement projects and so on and so forth. So you can see here, as we were in late 2000s, you saw these existing home sales really start to peak. One of the reasons why they started to peak was, there was more people working from home. People decided, hey, we need more room. I'm here and my wife. We have a 2-bedroom apartment in the city, or whatever the case may be. Maybe we'll move out of this, crowded metropolitan area and we'll get a bigger home, right? And so you really saw new home sales really start to peak. As we got into the kind of the first few months of 2021, we started to see existing new home sales fall. Now, the thing about that, though, is if you look at inventory around the country, there's not a lot of new homes or existing homes for sale. Okay, there's a lot of demand, and that's certainly driven prices up. Part of that inflation number, right? Why we had a hot inflation number. Now, what you also will notice, if you drive around town, you see a lot of construction going on. So new housing will come onto the market, and it is coming onto the market, and there's an awful lot of demand for it. So this isn't to say, hey, look, existing home sales fell off. As we all know, not a lot of inventory. Inventory is being built, and there's still a lot of demand for it. Here's a very interesting slide. It may surprise some of you to learn this, but Americans' balance sheets improved in the wake of one of the nation's most rapid and deepest recessions, which, of course, was initiated by the economic lockdown caused by the coronavirus. As this chart shows, Americans' net worth rose throughout 2020 while liabilities stayed flat. In part, a stronger balance sheet was the result of this very sharp and V-shaped recovery in stock prices and other assets, and this massive physical stimulus that sent trillions of dollars to American individuals and businesses. Again, remember, past performance does not guarantee future results, and the return of principal value of stock prices will fluctuate as market conditions change. In addition, as I mentioned earlier, shares when sold may be worth more or less than their original costs. But again, as you can see on this chart, this was the 2007-2008 recession that we had. Okay, you can see Americans' balance sheets went down as the price of real estate, as the price of their stocks. That was followed by this great recovery that we've had. You notice this little blip, okay, right here. This was the pandemic. Okay, you can see that V-shaped recovery, and you can see today and through 2000 and into 2001, Americans' balance sheets on average have people are worth more money today than they were before. So it kind of explains why consumer sentiment is the way that it is, right? Okay, let's keep working. Before we move on to our outlook for the second half of 2021, let's take a moment to consider the variables that could upend such forecasts. We see three major possibilities that could upset the otherwise optimistic outlook for the rest of the year and from what has driven the markets through 2001 thus far. The first, as I started to mention earlier, and we're going to dig into it a little bit more here in a minute, is inflation. As we discussed, the Fed has remained steadfast in its position that inflation is likely to be transitory, meaning, yes, we have some hot inflation numbers now, but they will cool. So as a consequence, the Fed sees no need to change its current accommodative monetary policy and this regime of near zero rates in its bond purchasing program. But what if inflation is not transitory? What if inflation just starts to exceed the Fed's goals of this 2% inflation rate? You know, the Fed had a meeting last month at the end of July. And of course, you know, at that time, we had the inflation rate at 4.6. Powell came out. Powell said, hey, this is simply a result of bottlenecking and pent-up demand. Even though we're at 4.6, we expect it to cool. And so we'll be right on average around our goal of 2%. But again, what could affect some of the optimistic projections that I'm about to paint would be inflation not being transitory. Another risk is bond yields. We'll talk a little bit about bonds, but many investors expect bond yields to increase for a good reason. Strong economic growth will drive demand for credit. But if that increase is higher and quicker than anticipated, it could unnerve investors. I'm going to unpack that. And then a deceleration in the growth of corporate profits also looms as a potential risk for stocks, which I'm going to talk a little bit more about. And then finally, and there's always this risk, it's the black swan risk, something no one expected, like a pandemic or, you know, two planes flying into the World Trade Center building. Of course, no one can predict what will happen in the future, but we hope the following perspectives will help you understand what we believe may be on the horizon for the rest of the year. So let's dive into the forecast for the second half of the year. Okay. After the 2020 fall in real gross domestic product, or GDP, due to the pandemic-induced economic lockdown, real GDP rebounded. As you can see from the chart, the Fed is expecting real GDP growth between 5 and 7% for 2020. This is an above average growth rate. And the Fed is also expecting for us to have a very good GDP number through 2022, again, someplace between the 5 to 7% range. In the long run, the Fed sees GDP settling into a more historical norms of someplace between 2.5 to 3.2. But you know, with people out there spending, people's balance sheets better, the consumer sentiment numbers looking very good, the federal funds rate being as low as it is, so access essentially to free money, you know, that's essentially what should help Americans go out there and spend more money, which again matriculates to GDP. And so GDP numbers looking very good, at least prospectively looking very good. Sometimes we look at what is called bottom-up earnings per share, and it kind of helps set the price targets, okay, for the S&P 500. And so what we mean by that, a bottom up, so very quickly when people, you know, I had somebody email me the other day and they said, hey, Derek, this stock just went public. You know, their biggest competitor is this other stock. The other competitor stock sells at $500 a share. This one's IPO'd at, you know, whatever, $100 a share. I think it's going to go to 500. And I said to her, why would it go to 500? That has nothing to do with it. It has to do with what they're earning. Okay. It also has to do with how many shares they have outstanding. But what I mean by earning, and most of you have heard me say this, if all of us on the webinar today, we owned an ice cream store in the 16th Street Mall, and I want you to pretend for a moment that that ice cream store brings in $1 million a year. However, we have rent, we have employees, we have to pay for the cost of product, blah, 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 blah. At the end of the day, we spend $900,000. So we're left with $100,000 of revenue. Okay. If we go to sell that ice cream business, we might go out there and hire some business brokers. We might go out there and hire, you know, some attorneys and some accountants and so on and so forth. But on average, what we're going to fetch for our ice cream store is 3 to 5 times earnings. In other words, somebody's going to write us, as the owners of that ice cream store, a check for $300,000 to $500,000, 3 to 5 times earnings, for the right to ring the register for our ice cream store for the next 30 years. And so what we mean by a bottoms-up earning per share strategy is we look at this and we say, hey, look, here's what this company is expected to earn over the next few quarters. Based upon what they're expected to earn, what is the average price for their stock? Okay? And so it's an analysis to look at, and when we look at that, especially with everything that I just painted, okay, wage growth basically offsetting inflation, the Fed believing that inflation's going to be transitory. In other words, it's going to come down. It's not going to be at this 4.6, and therefore wage growth is going to be much higher than inflation. Consumer sentiment being so positive, so on and so forth, people will be spending more money on whatever widgets, and there's pent-up demand for such widgets. Inflation will calm, and therefore when companies sell more widgets, profitability also goes up. Okay, but let's keep working here. So as you know, the first half of 2021 witnessed growing anxiety about inflation. We'll talk more about inflation now. Inflationary pressures exerted themselves into everything from commodities to consumer goods. Don't quote me on this price, but I was talking to a contractor and he said something outrageous. He said, Derek, I used to pay, $3 for a 2x4, and now the 2x4 is $71, right? And why? There's a ton of demand for it. You see a lot of building going on, but we see that all over the place. I filled up the other night at the gas pump, and, I only live about 3 miles from the office, so I only fill up, once or twice a month, and I was blown away by how much, it's $4 a gallon or something. So, as I mentioned, inflationary pressures exerted themselves into everything from commodities to all consumer goods. And there are several reasons for this. Supply chain bottlenecks as business attempted to return to normal, an uptick in consumer spending, so people out there spending more money thanks to a combination of pent-up demand and the physical stimulus payments that business owners and individuals got. The concern with inflation. So here's the other concern with inflation, right? I talked about one concern earlier, right? If you're driving to and from work every single day and you got to pay more at the pump, you have less to spend on widgets. But the other concern is this. So remember, the Fed's mandate, monetary policy. The concern with inflation is if you start to get inflation, that's hotter, right? Like this 4.6, the Fed, via monetary policy, will be forced to raise interest rates. When interest rates go up, it costs people more money to borrow, right? Everybody knows this. If interest rates go up, instead of you having your mortgage at 3%, it's now at 3.5%, right? Or whatever the case may be. It starts to tighten credit. When you start to tighten credit, you don't have as much spending going on. So the Fed has said, hey, we're not even going to think about raising rates until at least 2023. And really, come 2023, that's when we're even going to start thinking about it. But when we have a hot inflation number, okay, the market looks at that and they go, hey, the Fed can say whatever they want, predict whatever they want. But the reality is if we continue to have hot inflation numbers, the Fed's probably going to reverse course on what they've said, and they may raise rates sooner rather than later. The Fed, however, has been remaining very steadfast in its belief that the acceleration inflation will be transitory and therefore requiring no immediate action to curtail these hot inflation numbers that we're looking at. The markets, as I mentioned, may not entirely agree with the Fed, and we've seen some some of the volatility in the market over the first half of the year, and it was caused without a doubt by the inflation numbers. That said, okay, into the second half of the year, we also expect these inflation numbers, right, to wreak some havoc on the market. If we continue to get hot numbers, you'll see volatility in the market. If we get cooler numbers, market's going to really like it, okay? But I think it'll be kind of a mixed bag there. So the The next 6 months will be a better picture of inflation. It'll indicate whether rising prices are here to stay, or if that inflation is going to kind of hang around that Fed's target of 2%. And so we'll see. What you can also see here, though, as you can see on the chart in the grayed out area, is these are some of the expectations for inflation to continue rising. But you notice here, right, we're still at, about 2.5. So we're right in kind of that realm of around the 2%. And this comes right from the Federal Reserve's own website, which is called FRED. Okay, you can actually see this chart there. So what's ahead for short-term rates? Investors' inflation concerns may mean that Wall Street keeps one eye on the Federal Reserve's scheduled meetings in the coming months. Investors will be listening closely to the announcements coming from these meetings to gain an insight into whether the Fed will maintain its current monetary policy, or if they start to sound, more hawkish. In other words, hey, we're going to perhaps need to raise interest rates sooner rather than later. As I mentioned, the Fed just finished up their July, their last meeting. And in their last meeting, again, Powell came out and said, hey, we think this is transitory. We're not raising rates. Obviously, right, we have, another Fed meeting at the end of July, followed by September, and then one in November and one in December. And so this is going to be a really strong thing to look at, and inflation is going to kind of name the game of where we go here. The other thing is that I do want to bring up, and I talked about a little bit before, is here's another relationship to understand. As many of you on the call know, bond prices and bond yields have an inverse relationship. In other words, when bond prices go up, yields go down. After experiencing years of low interest rates, many investors may be surprised to realize that their bonds can lose money if sold before reaching maturity. Well, what in the world does that mean? Let's say, for instance, you go out there and you buy a bond for $1,000, and that bond says, hey, it pays 5%. Well, you're going to get $50 every single year. Okay, 5% against 1,000. And on the maturity date, let's say that bond matures July 8th of 2031, 10 years from now, the issuer of that bond, the company, the municipality, the government, or whatever the case may be, is saying to you, hey, we're going to give you back your $1,000. However, along that journey, along that 10-year period of time, on your TD Ameritrade statement, okay, or when you log in, it says to you, hey, somebody's willing to only pay you $800 for your bond, or $1,200 for your bond, or whatever price somebody's willing to pay you for that bond. So if interest rates go up, right, if we enter into a rising interest rate environment, the price of your bond will go down. Hey, I bought it for $1,000. I know I get the $1,000 back on maturity. Interest rates start to go up, the price of my bond goes down. The opposite is also true. So when interest rates came down during the pandemic and the Fed made those cuts in rates, bond prices went up. All of a sudden, somebody's willing to pay you, let's just pretend, $1,200 for your bond. And you say, Derek, why in the world would they pay me $1,200? And 10 years from now, they're only going to get $1,000. Yeah, but if you think about it, the bond was paying 5%. So that buyer of your bond, okay, they still collect the $50, okay? But their rate on that is now less than 5%. Their rate on it's only 4.1% because they paid $1,200. Yeah, they get to collect the $50 every year until maturity, and then at maturity they get the $1,000. But because they paid $1,200, what was their net rate of return? Only 4.1 because they paid more for it. Okay, so bond funds may decline during a period of rising interest rates. We made many of you aware of this 2 years ago when the Fed finally started to raise rates. And we kind of said, hey, guys, don't freak out. All your bonds are maturity. They have maturity dates on them, so on and so forth. But on paper, they'll lose value. It's this inverse relationship. And guess what? Through 2020, if you're on this call today and you own bonds, your bonds did fantastically well. Why? Because of the pandemic and the Fed cut rates. When the Fed cuts rate, bond prices go up. But again, you may see bond fund values decline during periods of rising interest rates. But a changing tide in the economy doesn't mean you have to abandon fixed income. I get this question about people, hey, should I just sell all my bonds? Often this movement is an important part of a well-balanced, diversified portfolio that may provide investors the income they need. So you don't need to abandon fixed income. You just need to understand it and what it's doing in the portfolio. However, keep in mind there is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification in and of itself does not protect against market risk. However, it's a sound thing to be considering. So stay focused on the fundamentals. Tuning out headline noise while managing your finances is not always easy. We completely understand this. However, wise investing involves more than reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on fundamentals like companies' earnings and real economic data. The headline news has a way of causing markets to gyrate in the very short term, but staying focused on fundamentals is always fundamental. I bring everybody back and I always show this chart. We've gone over a lot today. And if you remember just one detail from this presentation, I hope it's this. Emotions have no place in investing. Market corrections are a normal part of market cycles. We saw a vivid and compressed illustration of this between March and May of 2020. The chart shows the intra-year lows each year going back to 1980 in yellow or orange, with annual returns shown in gray. For instance, in 2020, we experienced a 34% decline in the S&P 500 intra-year, even though we ended up the year of the S&P 500 at a positive 16%. So again, those dots down the bottom are showing you from 1980 until today, okay, as of April 30th, what the market, during any time of the year, what the lowest point was, and then where we ended up for the year. You can see in every year, at one point down, we were down and often down pretty significantly. However, if you were to count all these lines and averaged it out, okay, you have 31 of these 41 years ending in a positive S&P 500 return, and that's over 75% of the time. So over the last 41 years, 75% of the time, you've had a positive return inside of the market. Volatility can certainly be uncomfortable, but it's perfectly normal. Managing your emotions during good times is just as important as managing the emotions during bad times. Ultimately, taking long-term views of the market is essential when pursuing your long-term financial goals and investing goals. If you ever feel concerned or want to understand what's happening, lean on us for support. We are here for you, and we want to help you make the most of your financial life. I want to bring up this other graph. This is quite interesting. This slide shows why it's important to tune out the noise and focus on your time horizon, risk tolerance, your goals, understanding your investment strategy. If we look at the past 15 years, we can see the danger of missing some of the market's best days. As the chart illustrates, a $10,000 investment made on January 2nd of 2006. Why January 2nd, not the 1st? Because the first markets are closed. So January 2nd of 2006 would have increased to more than $41,000 by the end of 2020, okay? Had an investor been out of the market and missed just 10 days out of that 14-year period of time, okay, of the best days during the period, that investment will be worth less than half as much, so only $18,000. That's missing the 10 best days, just 10. If the investor missed just 20 of the best days during the 15-year period, they would have an annualized rate of return of less than 1%. Okay, they only earned 0.88. Their 10 grand only grew to $11,400. 0.88. Heck, they would have been better in a money market or a CD. Okay, so just to kind of keep working down the chart, had they missed 30 or more of the best days, the investor actually would have lost money. 30 of the best days, missed 40 of the best days. You can see that they lost money. It's a very short amount of days over a 14-year period of time. Investors who sell stocks in response to difficult market conditions often do miss these all-important quote-unquote best days because they often occur when everything seems to be so negative. Again, this is showing you the S&P 500, right? This analysis was done with the S&P 500. Investors cannot invest directly into an index. You can get very close to it, but you can't invest directly into an index. Past performance does not guarantee future results. And obviously, the principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. And so we've gone through a lot of information here, and I'm sure many of you still have some lingering questions or questions you'd like to ask. Remember, if you're wondering something, we want to hear from you. Please reach out to us. We would love to chat with you. We'd love to answer your questions, and we encourage you all to send follow-up emails or book a time with us or whatever the case may be. On the next slide, again, you can email, you can call, whatever, but you do have these links. Set up a call, set up a GoToMeeting. If you would like, you can follow us on Facebook. We are finally allowed to receive Google reviews. We weren't allowed in the past. The SEC just kind of changed some regulations on that. So if you would, you can leave us a Google review, good or bad. That's in no way to solicit the review. It is just to say that you can, to inform you that you can leave us a Google review. So to kind of wrap things up here, this is the last of my slides. We also have additional educational webinars. If you were to click on this link, go to our website. If you go to webinars, as you can see down here, you can click on the link, and we have additional webinars coming up. I do not believe at this time there is any additional webinars to sign up for. However, typically we have 3 or 4. We'll start putting some new ones up around August. Obviously, you'll be invited to them. As my last slide, until next time, thank you so much for your time today. As you can tell, I'm very passionate about helping you understand the markets. There's a lot of information out there. Obviously, inside of these presentations, we try to take a 50,000-foot overview and put some things into focus. So remember, the market during the first half of the year was driven by economies opening back up, a huge stimulus package of $1.9 trillion being passed, fiscal policy being very accommodative. The Fed is in there buying bonds. The package that put money into Americans' pockets. For the second half of the year, we're going to have some volatility, right? This inflation number is scary to a lot. They think the Fed will act beforehand. If they do, it throws off all the models. Why does it throw off all the models? Because back to that earnings, right? When I said earnings, and I was talking about our ice cream store. Okay, well, think about it. All of a sudden, right, inflation goes up. Mom and dad don't take the kids out for ice cream on Saturday night, and therefore there's less people in our line, right? And so all these things play into each other. Again, our kind of forecast over the next 6 months is you always hear the saying, don't fight the Fed. The Fed has over 100 PhD economists working there. When Powell's out there saying he believes that inflation is transitory, you gotta believe him, right? The market tends to get it wrong when they don't agree with the Fed, and the Fed's very crystal clear today about why they make that recommendation. So we have to lean on the side of trusting the Fed. Consumer sentiment reports look very good. the fact that balance sheets look very good. We believe that some of the gyrations in the market will start to close that gap and meet up to expected earnings. And, obviously there's other events, this Delta variant, we'll see where that kind of goes with everything. Obviously shutting down of economies could be kind of nasty, but as I painted, things are pretty strong. Our speedometers, our economic outlook, as I showed you, looks very good, and we'll keep trucking forward. So anyways, again, thank you all for joining the call today. Hopefully some of you took some of this and learned something. Again, any questions, feel free to email, feel free to call, feel free to reach out. And lastly, before I end the meeting, if you want to download these slides, they are again made available to you in the handout section of your GoToMeeting bug, if you will, that little thing that popped up on your screen. Go ahead and click on those PDFs, and you can download that right to your computer to review the slides if you would like. Also, I believe that this will be recorded, and you will all receive a recording of this presentation if you'd like to watch it at a later time. Anyways, thank you so much. I'm signing off for now, and look forward to chatting with everybody. Thanks again, and have a wonderful rest of your day. Happy 4th to all of you, and being that it's Thursday, have a wonderful weekend ahead of you. Thank you so much, and have a great day. Signing off for now, Derek Eichenwald, Triumph Capital Management. Thank you so much. Bye-bye.